Hello, welcome to Super Return Asia. I'm Sarah Clark in Hong Kong. I'm joined by José Feliciano. Thank you very much for joining us.
Thank you for having me.
You're the co-founder and managing partner of Clearlake Capital Group. Let's talk about the late cycle investing in a world flush with liquidity. It's been a decade since the Lehman Brothers collapsed, and the current economic market expansion has lasted for over 9 years. How much longer can this last?
Well, it's interesting, right? We spend a little less time trying to predict exactly when a downturn correction would happen, but you're absolutely right. You're seeing all the elements right now of a potential downturn. You see basically a combination right now, a confluence, if you will, of very high equity valuations, very robust credit markets, and at some point we will have that type of correction. What the catalyst may be, it could be anything, right? It could be the current trade wars that we're experiencing. It could be an exogenous effect, like some type of sociopolitical event. What I think is the case is that any single investor in any single asset class right now should be preparing for a potential downturn.
Okay, but you mentioned the current trade war. Are the current trade wars dimming the positive trends on the broader global economy?
I think they are. In today's increasingly interconnected world, every single company, particularly in the industrial manufacturing world, depends on every other region. And we're seeing right now, from a small, maybe middle market firm company in the US, you're going to be buying commodities, you're going to be buying steel, you're going to be basically being affected by those trade wars, and you're going to have to respond to that in some way. You're going to have to pass on those price increases to your customers, or deal with that, or deal with kind of diminished profit margins. So I certainly think that people are getting affected across the world, and it's certainly affecting how we think about investing in today's environment.
Okay, back to looking at the cycle. Should investors be wary of where we are in the cycle?
Absolutely. I think every single investor in every single asset class should be thinking about, how do I protect myself, or how do I prepare myself for an eventual downturn? And that could be thinking about specific sectors that may be more insulated to a potential downturn. It could be using structure or valuation to protect yourself. But you're doing that in an uncertain environment where we don't know when the timing may happen. So I think investors will be prudent to think about every single time they're making a new investment, thinking about kind of where we are in the cycle and how to insulate yourself in the case of a potential downturn.
Okay, what should the game plan then be for the late cycle private equity investing be? How do you prepare for tougher times ahead?
Yeah. So we have done it, at least at Clearlake, we have approached it a number of different ways. First of all, when we think of companies and sectors, we're trying to focus or overweight sectors that we think are going to be more resilient in a down cycle. And one example of that would be some technology companies where a potential cyclical downturn may be mitigated or completely offset by the secular trends, very positive secular trends that we're seeing in that sector. The other way that you can do it is valuation, right? You have to be very disciplined in terms of valuation, and we have done that. Lastly, there's structural protections, right? When you're doing a buyout, you want to make sure that you don't have any triggers, debt covenants and the like, that could potentially take the company through a difficult time period. You also can do it by using structure, using structures that structurally, contractually, give you downside protection, but at the same time give you that upside optionality, gives you the ability to make 2-3 times your money. So we have done all the above, particularly in the past 2 or 3 years, and I believe that will serve us well in the case of a potential downturn.
Which private equity strategies are positioned well in this current market?
Well, one of the things that we have been emphasizing lately in our latest deal was a structured equity deal. So it was basically a transaction where we took a minority equity stake. There was a modest amount of debt, in the structure, and then a lot of junior equity behind us. And we were able to create what I was talking about before, a structure where you have a lot of downside protection. In the worst case scenario or bad case scenario, you make 1.5 to 2 times your money. But if the environment is benign or the company does extremely well, we can still have the opportunity to make 2, 3, 4 times our money. That type of kind of a structure I think is pretty interesting, and we call it structure equity, but I think that you're going to see a lot more of that.
Which segments in the private equity space, which ones are going to be the most challenged?
I think obviously in a downturn, kind of things like pure play growth equity is going to be a little more challenged. Any type of any type of strategy that depends a little more on momentum is going to be a little more challenge. And obviously strategies like distress or turnaround may actually see a kind of a renaissance or a really interesting opportunity to take advantage of a dislocation in the market.
Okay, Jose, thank you very much for joining us.
Thank you.
And thank you for joining us. And you can see more conversations like this on Twitter. Just look for #SRAsia. Bye for now.